When you're buying a company, it's an auction, and you want to position yourself as being good guys and partners, and we're going to come in and we're going to be hands off, and we're going to trust you to run the business. And unfortunately, that doesn't happen, because I think in general in PE, 70% of CEOs get fired in the whole period. So there's something broken here.
Welcome to another episode of Source Code Sessions. And today I've got Lee McCabe with Claymore Partners, and we're really excited to dive into Lee's background because I think he has some really refreshing takes on private equity and investing as a whole, and what actually drives the needle in creating value, because the industry has experienced a lot of change in recent years where there's a lot more emphasis being placed on value creation and operational expertise as opposed to just, financial capabilities and the ability to source and structure and kind of exit deals. So Lee, really excited to have you on.
Thanks for having me.
Maybe you could just start by doing a quick introduction to yourself and your background and how you got to here at a high level.
Sure. So Lee McCabe, partner at Claymore Partners. We're basically an outsourced operating partner for PE firms. My background was largely digital. I founded digital early with eBay in the UK, then had a few gigs with startups, and then ended up running Asia Pacific for Expedia for some time. That led me to Facebook, where I ran a few global verticals at Facebook, including the global travel industry. And then I joined Alibaba to run North America when they had aspirations to grow that business and really globalize that business. And then it was really when I was at Alibaba that it opened my eyes to private equity, because one of my jobs there was making sure the major North American brands were selling into China on Chinese platforms, Alibaba's platforms like Tmall. And yeah, I learned a lot, because every time I was talking to a brand, I ended up talking to the board, and I started to realize that a lot of these boards were made up of PE guys. And it opened my eyes to the grasp that private equity had across most businesses. And it also opened my eyes to how not digital private equity really was. And being a digital guy at the time, and still am, it just struck me as crazy that digital wasn't one of the major value creation drivers for private equity. So I left Alibaba and set my sights on getting into PE, and took 6 months off and talked to a lot of PE firms, and ended up working for AE Investors, who were great, for 5 years. Big business, about 20 billion AUM, 45 portfolio companies. So I worked across those 45 portfolio companies driving digital value creation, and then left in January last year to start my own business, really doing the same thing, but opening my scope so I can work with lots of PE firms, not just one.
Yeah. AEA is a great firm, also a former Source Code client, so I can't speak highly enough about them. But I tend to agree, and I think there's two sides of digital for PE firms, right? There's the value creation lever that digital presents, because so many of these businesses really don't have any professionalization of marketing. But there's also the marketing of the firm itself. But maybe you could just talk about that transition into being an operating partner and how you went about getting that first role, because I think that's really difficult for a lot of people going into a corporate or a startup environment and kind of breaking down that first barrier to get into private equity.
Getting in is tough, and it's really perseverance, networking. Like I said, I took 6 months and tried to, have as many conversations as I could with PE firms. And to be honest, there really wasn't that many. It was a lot harder than I anticipated, because, as you know, these PE firms are getting bombarded every day. And when I joined PE, I was getting bombarded every day with resumes and outreach from vendors wanting to work in PE. So it was tough, but I ended up having, a handful of conversations and started having great conversations with AEA. And it was really about positioning that angle about digital value creation and the opportunity across the portfolio to put that in place.
Yeah. And I think that's what, the nature of being in the seat at private equity, like when you're working on a deal, there's so much riding on the operating partner, the executive team, that it's very difficult for them to be in situations where they want to risk it with someone new. right? Like it's even with vendors, it's very hard to convince them to take the risk. And they always want to try and find out if something can be successful in a de-risked environment, which with an operating partner, it doesn't really exist.
No, it's rare, and you're right. And when you look at the history when they hire operating partners, it's typically guys they know, because it's a lot safer, right? If they've worked with great guys in their portfolio, they might work with several years. It's much easier to bring them in-house than somebody new. And I get that, because it's really all about trust. Most PE firms are not big firms. Even the biggest ones, well, not the major 10, but I said mid-market, you're probably talking 100 to 200 people. And then you've got ones much smaller than that. So they want to absolutely make sure that they can trust this person. And also this person's going to bring value and they're going to be accretive.
But it's also why once you get in, it can be such an attractive universe, because if you're successful in it, they want to work with you more. But it's that the risk isn't the financial risk to them of paying someone. It's the opportunity risk of the hold period not being optimized, right? Like, even taking 4 months to find out someone's not a fit, that's a huge percentage of the time they plan on owning it.
Yeah, but look, that's the risk in hiring as a whole. It's a risk in hiring to the firm. It's a risk in hiring to the portfolio companies. And the truth is, you never really know about somebody until you've worked with them for 3 to 6 months. Because I've interviewed people who have crushed the interviews, and I thought this guy's going to be amazing. And 3 to 6 months in, they've turned out to be lemons. And the other way, I've interviewed people who I've thought, okay, I think that this person might scrape it in, and look, we'll give them a chance. And they've turned out to be awesome. I think that's just the problem with hiring in general, right? It's a crapshoot. I think there are things emerging where you could be more diligent about that hire. But no matter how diligent you are, you still never know until that person's been on the job for 3 to 6 months. And then you really see that person who they truly are, and you can really figure out if they're going to perform or not.
Yep. And so for executives that maybe come from a corporate environment or another, similar non-sponsor backed environment, is there any advice you could give them in like best preparing themselves, for that environment and the process of breaking in?
Well, research the firms, research the partners in the firms, go in and be very knowledgeable when you get that chance, because the chances are few and far between. So, if you get the opportunity, make the most of it. Look at the portfolio, and also have a very clear angle of the value you're going to bring. When I was there, I was getting hit all the time with resumes and applications to come in, and they were very generic. We'll create value. I think you have to be very specific about what you're going to do, and also be very clear how that will translate across the portfolio. So if the portfolio is a mix of, industrials and consumer, I think you have to be very clear how what you bring to the table is going to be effective across the board, not just to a small segment.
Got it. And when you started at AEA, were there kind of, companies or platforms that had been identified during the onboarding process where you're going to start? Or what was that kind of transition into actually getting involved with some of the portfolio?
Well, I was the first kind of digital guy, the digital operating partner. So there was really, to be honest, a lot of figuring it out. And the easy part was, the identification of value creation was easy, because there's opportunities across every business. It's very rare you come across a business and there's no opportunity to drive value creation in that. So it was really start building those relationships, start talking to portfolio companies, because trust is paramount, winning the trust of the CEOs and the portfolio companies, then identifying the gaps and being very clear about what needs to happen, what plans need to be put in place, and then what value you believe that will drive.
Yeah. And was there kind of, quickly, was it spread, were you spread thin across the portfolio, or were you able to kind of dive deep in a couple? Just what did that look?
It's kind of the team model, right? Because you try to work across the full portfolio, and then you find yourself probably working with 10% very closely. And it's dependent on a few things. One is dependent on the kind of the amount of value you can bring. It's also dependent on the openness of the CEOs who actually want your help or not. And the CEOs that kind of realize the value in this and say, yeah, we'll have all the time you can give us, then the job becomes very easy. because you can go in and really partner with that CEO, develop a value creation plan, and execute.
And were there any common themes that you saw across these businesses in terms of, there was consistent, shortcomings or value or opportunity that you could kind of see as low hanging fruit?
People is always the biggest one. The PE invests in a lot of old industries, and these industries have been successful for the past 20, 30 years. But the emergence of digital and now AI, if they don't have that talent, they're not going to be successful for the next 20 years. So people and talent is always the biggest driver in PE, probably every business. But I think the other gaps were kind of the tech stack. These businesses really were building a tech stack for themselves to do two things: to make the customer journey efficient and to measure everything in their business. And I think foundationally, every CEO, I would hope, would say, yeah, I want a business run on data. And that's possible now. You would want them to say, I want to measure everything in my business. I want to understand on a daily basis what's going on so I can identify the drivers and double down on those. I can identify the problems and fix those and build a great business out of that. So the foundational work is really building a tech stack for measurement. So everything is tagged and tracked. You know where every phone call is coming from, every lead is coming from. Your sales team have a good working CRM. They're managing the pipeline effectively in the CRM. It's really giving the CEO that full control and visibility of their business. I didn't see many businesses where that was in place, and that was the first opportunity. And if you do that, if you build out that foundational element first, then it becomes pretty easy to build on top of that, because you can improve your website for conversion rate. And you've got all the data. You know what works, you know what drives phone calls, you know what drives web forms, you know what drives transactions, and you can iterate and improve that all the time. And then the marketing becomes easy. A lot of these old companies were really stuck on traditional because that's where the founders had come from. They were spending probably 80% on TV and radio and just dipping their toes on digital. Now you should flip that. There's still a room, and you have to build brand. So there's still room at the top of the funnel for TV and radio. It's tough to measure, which I hate, but it's still important to build that brand. 70, 80% of your budget should be digital. And that's a lot of the time, it's what these companies didn't have the talent to run that digital component of the business and didn't have the know-how to do it. So those are the major gaps. And if you've built the tech stack well, again, if you can measure everything, the digital marketing is the easiest part, because really it's just marketing on platforms and Google's platforms.
So when you think about building a funnel like that and the infrastructure it takes, right? Where do you start when you're coming into a business like that maybe has very traditionally successful channels like TV or radio or sponsorship or what have you? What is the first steps to kind of reevaluating a funnel and thinking about how to rebuild it?
Well, the first step is understanding if the CEO wants it or not and believes in it. And if the CEO is on the fence and doesn't think digital and data is a thing, don't waste your time. I learned that lesson. The education is too long and it's futile. So first is CEO buy-in. If the CEO is on board and says, absolutely, look, I recognize we haven't moved as fast with the times as we should have, and we need to digitize this business, then it becomes easy. And you start with an audit. You evaluate everything. You look at the tech stack and say, okay, what have we got in place right now? What do we need to fix? What do we need to change? And, I'm reticent to swap out big platforms if it's not necessary. And a lot of times you can you can connect things very well with what they've got in place, as long as the team are using them. If they haven't got the platforms in place, like if they've built their own CRM in-house or they're using an old CRM, those are the things you should swap out and probably go with something like HubSpot. So it's evaluating the tech stack first and saying, okay, what do we need to put in place first of all? Actually, a step before that, which informs the tech stack, is mapping out the customer journey, which a lot of companies don't bother with and don't really have full insight into. So you map out the customer journey first and say, okay, this is how we think the customer should flow through our business. From marketing to the first touch. Now, for the first touch, there should be a lot of touches after that with the customer, right? Until you get them to transact. After they transact, there should be more touches with the customer. So it's mapping out the customer journey, and you both sit at the table and you say, okay, yeah, this is our customer journey. And we say, great, okay, what do we need to build to make sure we are touching that customer efficiently and effectively and pushing them through that journey as efficiently and effectively as possible. So that's all in the tech stack. And once you build out the tech stack, that's really the hardest part of it and the biggest hole, because you do that and then you can build BI on top of that pretty easy because you're ingesting all the data, you're bringing all the data in the business that you need. Then you just drop into something like BigQuery, you put in a visualization tool like Looker or Tableau on top of that, and you give the CEO all the data they need to run that business well.
It's funny. So one of my last guests was someone named Ryan Frederick, who runs a firm that kind of for 15 years has been, developing software and now AI for really middle market operating companies, not necessarily traditional technology companies. And he echoed so many things that you said, right? The most important success, the thing that drives the most success and what they see is just is leadership buy-in. Right? Like, how committed are they to actually figuring this out? Because it's never going to be easy, especially if you have to rebuild or produce a new CRM. But the end goal, right, is always to be, again, what Ryan would say is a good data company. And oftentimes, the hardest part about being a good data company is actually collecting, centralizing, and making that data into a place where you can actually use it to make decisions.
Yeah, and look, and some leaders may be reticent to do that, and I get it because they might feel threatened because they've run a good business for a long time and they've been successful and they've had a PE firm buy them. But it really, when you digitize the business, it makes that business very transparent, and it also shows issues in that business and shows gaps that probably should have been filled a long time ago. So you also have leaders that are reticent to do that because of the exposure.
And I think a lot of our audience are, lower middle market investors who are buying companies that I would say even are the subscale smaller than AEA, right? These
Yep.
companies that might be doing anywhere from 2 to 8 million of EBITDA as a platform. And those companies tend to be even further behind on digital marketing or marketing because they've just had less resources. But in the same time, there's kind of less there. So you have oftentimes have a quick path to rebuilding it. So when you think about going in and building this funnel, how do you think about doing things in-house versus using vendors and what that looks like to kind of make sure that you're getting from point A to point B at the speed that the sponsor wants?
Well, first of all, I'll answer the first point. I think it's easier for smaller companies because you're probably not sitting on any tech debt, right? You've probably got pretty simple systems that makes it easy to switch out or makes it easy to improve. So that's the easy part about that. You're also probably up against less resistance because when you go to a big company, you're not only dealing with the CEO, you're dealing with the CIO, you're dealing with the CMO, and sometimes there's a lot of resistance. Because they'll say, look, it's been working so far. If it's not broken, nothing needs fixing. So you come up with a lot of resistance there. So smaller companies, I think it's a lot easier to set them up on this flywheel and just create, lead generation machines and value creation machines and building that tech stack quickly. And now it's easy to do off the shelf. You're not paying hundreds of thousands to develop websites. You don't need modified systems. You can buy everything off the shelf and connect them. And I think to answer your second question, I think vendors are hugely important, but it's a minefield, right? It's picking the right ones. There are a lot of cowboys out there, a lot of digital agencies I'm not a big fan of because they don't position themselves as business owners. They think they're marketers. They don't take accountability for the outcomes of the business. They just concentrate on the channels and drive SEO and PPC and social. And, they'll turn up to meetings with 200-page PowerPoint decks and 10 people on a Zoom. You've got no idea what these people do. And they'll talk about vanity metrics all day. So I think it's picking vendors that are business minded and view themselves as business owners. Or else why would you hire them? You hire vendors to make more money for you, not to drive clicks and impressions. And there's one question you should ask every vendor. It's how much money did you make me last month? That's it. I couldn't care less about clicks and impressions and conversion rates. At the end of the day, it's EBITDA. How much money did you make me? So I think you should use vendors. I think it's a minefield, and I think a lot of companies have picked bad vendors because they don't know any different. Because a lot of these companies, the leaders are not digital. So they kind of, it ticks a box for them. They'll pick an agency and say, great, I've got an agency and I've hired some kid who's done social media for 2 years and I've got a head of digital and I'm good and I'm aware. And the problem is that they don't know what good looks like. So I think you should use vendors, but you should be very careful of the vendors that you choose and figure out how you're going to use them and put their arms and heads on a block and say, look, I'm paying you to drive business for me. You need to show very clearly how you're driving revenue and EBITDA for my business. So I think you should definitely use vendors. Over time, you should bring it in-house because when you exit a business, it's always better to say, look, the secret sauce is in-house rather than I work with several vendors. So I think you start with vendors and you start learning what's good and what's not good, and you start building that value creation engine. Then over time, you start thinking about filling out your team and bringing that in-house. So you absolutely start with a head of digital or a very digitally savvy CMO or CRO, and then let them slowly build a team underneath them. So eventually bring PPC in-house, eventually bring SEO in-house, as long as you can hire good people. But again, like we talked about earlier, hiring is tough, so it's always a balance. But that's how I would think about it.
Yeah, and it's interesting when I think about the talent drivers in marketing, and you'll see this a lot, I think, in the M&A market for agencies right now. Whereas 3 or 4 years ago, the bottom of the funnel, programmatic kind of conversion metric based were some of the hottest assets and talent on the market. But AI has kind of changed that in a way where it's commoditized some of that, and the creative and the strategy and the ability to bond with the consumer and create top of the funnel, full funnel campaigns is where a lot of the talent value is right now, because you can't really use AI to do that. You can use AI to empower that person and maybe make them better and give them more throughput, but you can't really replace it in the same way some of the other stuff can be.
Yeah, look, AI is going to, I want to say decimate. Maybe that's too brutal of a word to use, but it's definitely going to impact agencies. It might wipe out the bottom layer of agencies, but for now, it won't wipe out the decision making. AI is going to come in and make you a lot faster. It's going to make you a lot better. It's going to help you understand that business a lot, but it's not decision maker. It should be used to empower the decisions that you make and make those decisions faster and better.
Yeah, agreed. Allow one person to do more, right? Than ever before. So when you think about, the operating partner model and what you saw what worked, what didn't work, maybe you could just talk about what was successful and how AEA deployed operating partners, what really worked, and kind of allowing them to maximize their effect on these platform companies.
Well, look, I'll talk about it in general because now I work with a lot of PE firms and have been exposed to a lot of PE firms. I think what works, I think, yes, you definitely need that operating capability because the time of free money is gone. It's getting a lot harder to just depend on financial engineering. You have to drive value creation in these businesses. So you have to have operating capability in-house across these PE firms. And what works is back to the CEO. If you've got CEO buy-in, it works perfectly because you can go in and get the job done and you can bring in the vendors that you like. You can create a vendor bench for them. You can drive that business very well. It falls down at the CEO resistance. And I think in general across PE, that's the tough part that they really haven't worked out. And I get it. It's not clear cut, right? Because when you're buying a company, it's an auction. And you want to position yourself as being good guys and partners, and we're going to come in and we're going to be hands off. And we're going to trust you to run the business. And unfortunately, that doesn't happen because I think in general in PE, 70% of CEOs get fired in the whole period. So there's something broken here. So I think, you need to come in and find a balance to say, look, we're going to be hands off, but we also know what works. So we are going to come in and change some things, but we've done this 50 times and it's going to improve your business and it's going to improve you. And I don't think there are many PE firms like that. From my experience, I've seen a few or heard of a few, maybe the SaaS investors like Vista and Toma, who will buy a business and will be very clear up front that, look, we have playbooks. So as soon as we start partnering, as soon as we buy you and we partner with you, this needs to be done day one. And it's usually things like tech stack, the obvious ones, like we're going to come in and we're going to build you a tech stack that works. So we can both measure everything and help you drive your business even more. And we're going to fix the back-end tech stack. We're going to fix cyber and your ERP. We're going to put that in a good place. And then when we've done that, we'll build out BI, and then we'll help you with the marketing. And to me, that's a kind of a pretty obvious one, but I think it's all about positioning with the PE firm of how you do that. And again, I don't think it's clear cut because, look, PE firms are financial institutions. They're not at heart operators. And the best PE investment is a company that you buy and you never talk to for 4 years and then you sell for 3x. That's the ideal private equity investment, right? I mean, ideally, the PE firm wouldn't get involved at all, but invest, hold for 4 years and walk away with a very good exit. But unfortunately, now you have to. You have to get your hands dirty. You have to work with people. You have to manage people. You have to have a very value creation driven strategy, and you have to make sure that's executed on day one, or else it's too late. A lot of firms will stick around and give the CEO a chance, and they might not really get into year 2 where they realize, okay, shit, this really isn't working, and we have to change things around. Or even worse, when a company's getting restructured or close to bankruptcy and they've got no choice to send people in and help that business. But by that point, it gets really hard because the company's very low cash flow and low on investment, and there's not much you can get done at that point. So I think and it's a cultural issue. So I think that's the biggest thing that's broken is the cultural issue in PE and how they work with their portfolio companies.
Well, I do believe that one of the areas that private equity traditionally has not done and to this day is not very good at is marketing themselves, right? Like, and it's not marketing themselves it's really to owners, right? Because LPs will follow returns, and the thing that you really need is deals, and you want the best deals, and you want the best owners, and you want them to want to work with you for reasons beyond commas and a check. Because if they're just going to sell to the highest bidder, then you're going to be the highest bidder to win, right? So the ability to tell a story on how you add value in a way that isn't intrusive, that doesn't feel like you're necessarily tearing everything down, but also makes it clear, like, yeah, we do have expertise. We do have a bench of resources that we want to leverage, and we want you to want those resources because it makes your company, your equity more valuable for you, your team, your employees, and everyone associated with it.
Yeah, look, I think that's an opportunity for private equity as well. When you look at 99% of PE websites, it's really a pitch deck for LPs. And there should be, of course, be a component of that. But if they did it right, it should be a pitch deck for owners because it's better to attract than chase. And most times PE are chasing deals, right? They get deals bought by banks and they get put in an auction process and they're chasing. And most of the times, the owners have never heard of these PE firms. If you ask an owner to name some PE firms, they'll name the big 5, right? They'll name Blackstone and KKR, Carlyle, Apollo. It's typically not those firms that are in market to buy these businesses. So they'll have no idea that it's a complete cold relationship. These PE firms will come to them and they'll wine and dine them and they'll do the diligence. But these companies and owners don't really know them. So I think PE should take a leaf out of VC. VC do a much better job at this. And companies, of course, the big ones like Andreessen will say, look, we're pretty much a media firm as well. And they put out a lot of content. And that's made them, look, of course, they've been very successful investing, but that's made them attractive for owners and startups because they feel like they know the partners already. They feel like they know the firm already. It's not a cold interaction. 20 VC is another good example who Harry Stemmings will say, look, this is a 50% media company and he started with podcasts. It's 50% investment firm. And I think that's really smart because you should be just putting content out there. And now it's a creator economy, right? You should be putting as much content out there as possible that's really aimed at owners, showing why you are the good guys, being very transparent about the firm, being transparent about how you've made owners successful, what it's like to work with you, past successes, share the playbooks, exactly how we did this. What did we put in place to take this company from 10 million revenue to 50 million revenue? Share everything.
Yep.
Because the other thing is that there's no real secrets, and there's a kind of a mystique around PE that it's a private society and there's lots of secret sauce. And there really isn't. What you have to do to drive value, there's no secrets in that. So you should be sharing that. You should be sharing the playbook, sharing what you've done, share exactly what you like to work with, share how you're going to make owners successful. And I think if you do that, you start creating a very good brand for yourself, and you'll create deal flow. Owners will start coming to you. If you ask owners, what PE firm would you like to buy you? Hopefully they go, well, we saw this one because we've been following them on LinkedIn and we've listened or watched their podcasts. And they seem like good guys who know what they're doing. They feel like they'd be great partners. So you start creating deal flow for yourself. Or if you do get caught in an auction, hopefully that company has already heard of you because they've been exposed to all your content. And that definitely gives you the leg up, because owners don't always take the best price. They want to make sure they're going to get in bed with a good partner who's going to be great to work with. So I think that also gives you leverage there.
Couldn't agree more. I always tell firms we work with, like, the better content you have, the better you can engage with owners, right? And the best way, I think, to tell a PE firm story is through the words of the owners you've worked with, testimonials,
Exactly. Exactly why you're doing a podcast.
Exactly. Well, we believe the same way. Like, the way to build trust with owners to get them to the table is through value added content. How can we produce things that actually add value to them in a way that before they ever want to talk about an M&A transaction? Because again, we're dealing with typically smaller companies, right? 1 to 7 million of EBITDA, where there's a huge education piece for owners. And these companies often have, like any, gaps in areas where they operate. And it's not that they don't know there's gaps, it's they don't have the balance sheet, the P&L, and the expertise to fill them. So if we can produce content that we put a lot of effort into and that really adds value, we think that there's a lack of quality trust in this market, and that there's a lack of quality brands, and that if you can establish yourself as that, it'll be incredibly powerful now, but more powerful even in the future.
Yeah, and good content compounds because it's around forever, right? And these relationships with owners are also long relationships. You want to be exposed to owners now that may not be in the market to sell their business, but they might be in 3 or 4 years. So the value of getting in front of them now and dropping all that quality content, dropping those breadcrumbs and just getting in front of them, you may not see a benefit from that straight away, but over time it compounds and you should see a benefit at some point.
Yeah. And it's funny, like, we're the same way. We were just making content around, we rebuilt a kind of our cold calling infrastructure and dashboard and how the data kind of moves into our data warehouse and everything like that. And we went a lot of in depth and, like, hey, these are all the vendors we use, why we use them compared to other ones. And it's my partner was kind of like, hey, this is giving away a lot of information. And I'm like, look, if somebody wants to put the effort in to recreate this and build their version of a data warehouse, and if they can do all this, they were going to figure it out regardless of me saying it. Right? Like, because this isn't rocket science. It's having the expertise, the network, and the experience to put it all together and actually execute. That's where the difficulty lies. It's not in kind of mapping the road.
No, and I think it adds huge brand value to be authentic and transparent. I think there's a huge halo there because it shows, these guys are not into secrets. They're transparent. They share everything, and there's huge value in what they're sharing with me. And I think it gives the perception that, these guys know what they're doing and they're very open to helping. And there's no closed doors.
I also actually think it does a lot to create a curiosity gap. It's almost like, when you see the plane that the U.S. military has, you're like, well, if they're showing me that, what do they have, behind the doors? And I think there's an element of that when you're transparent as well, where it's like, what else do they have? What else can they do that they're not telling us about? And the more that you just get people thinking and talking about you and associating you with those things, the better.
Yeah, I think it's all about building that audience. And distribution, you build an audience. If you have a big audience, that gives you distribution. And distribution is a major moat in any business. That's what's given rise to this creator economy. And the many success stories we see of people who have just started a business on their own, they've just started posting on Instagram or TikTok or LinkedIn, and they've quickly built up a following. And that following has given them a lot of leverage and optionality to message that following, sell things to that following, influence that following, and build a real business out of it.
Yeah. No, couldn't agree more. Couldn't agree more. Well, to shift topics a little bit, you know, I think especially in the lower middle market, there's more and more firms, but there's also more and more firms utilizing operating partners. So when you think about the things that you've seen go wrong with operating partners, maybe you could just talk about that.
Yeah. The things that go wrong are one, not being clear about how you add value to the business. It's back to the conversation earlier that trust is the paramount. If you can't win the trust of the CEO, don't waste your time. That's the major thing you have to do. If you win the trust and it becomes a true partnership, then the CEO will open the doors and say, okay, we're partners on this. I don't feel like you're stepping on my toes. We both got the same goal of making my business successful. Right, let's map out how we do that. So I think one, it's making sure you have that trust first. And then I think it's building out a very clear plan that is metrics and outcome driven. Not maybe try this or try that or and introduce you to somebody. It's having a very clear roadmap of how you think you can impact and improve that business, and then getting the CEO's buy-in, and then being on hand to help that CEO get that done as quickly as possible. And being helpful is one, hopefully you have the knowledge to be directly helpful to that CEO, but it's also having a bench of partners and vendors that you trust, because that saves a ton of time. If you don't have that and you're both looking for partners and vendors together, you're going to pick some bad ones. Because back to the other point we made before, it's like people. You can interview a vendor and they can give you the best pitch, and they'll show you case studies and success stories. And typically they'll pitch with their A team, and then you get them, and 3 months in, you find out you've got the C team on the business. So I think an operator who comes with that arsenal and that bench of credible vendors and trusted vendors that they've worked with for several years also counts a lot. And that's a massive value add.
Yeah. Couldn't agree more there. And I think with vendors, one thing that can be tricky is understanding that maybe the vendors that work, if you're, the VP at a large, Facebook or Meta, the agency you use there is not going to be the agency you use when you buy a $3 million EBITDA plumbing company, and how you can kind of understand how to reconcile some of those differences, maybe with your past larger corporate experiences.
No, you're exactly right. And I had to rebuild that vendor bench when I moved into PE, because my experience with big tech, and you're quite right, the vendors that I worked with at Alibaba and Facebook and Expedia are not the vendors you should be working with and low middle market portfolio companies. So it was really a case for a short period of finding better vendors, finding more vendors, finding smaller vendors, figuring out what worked. The thing that did make that easier was I had a portfolio company of 45 companies. So I could ask them, who do you like? Who you're working with right now? And like, why do you really like them? Are they definitely creating value for you? Not just that you like your account manager, and that's an easy one, but show me how they've created value for your business. So you had I had a kind of wisdom of crowds. So I didn't start cold to say, okay, so there's one agency here that's working with 3 of our portfolio companies and they seem to be doing a great job. All right, that gives me a lot of confidence to, one, meet that agency to understand that they really are doing a great job, but then introduce them to others. So you should also, as an operating partner, leverage the learning of your portfolio companies, because you don't have scale. Typically, there's only one of you. And in your portfolio companies, while every one of them won't be awesome at digital, you'll have a handful that have great digital people in them. And you can learn a lot from those guys, because they're talking to vendors every day. They're using vendors. They've swapped out vendors. So you can accelerate your learning pretty quickly by listing the portfolio and finding vendors that way.
No, that makes a ton of sense and is a great point. So, obviously for you, now that once you decided to leave kind of working for an institutional investor and pursue, more entrepreneurial things, social media has been massively effective for you. And I think there's a huge push now, especially among the junior kind of workers within PE and some of the senior ones as well, to build personal brands.
Yeah.
Maybe you could just talk about, what has worked for you in that space and what's really been the results.
Yeah, well, look, first of all, I think everybody should build a personal brand. Now it's free, and it's about, again, back to building an audience. There is no downside in building a big audience for yourself, and the platforms are out there and they're free to do it. The key is good content. Just start posting good content, and over time you'll see more followers, you'll create interactions, and you start building a great personal brand for yourself. So I think it's just as important nowadays building a personal brand as it is building a brand for your business. So I think you should spend as much time as possible thinking about that. And again, you might not see the benefits straight away, but good content and that brand building compounds over time. So you will see a return eventually. You just have you just have got to have the discipline to say, okay, this is my persona, and you shouldn't change that. You should be authentic. You should have post authentic and transparent content, and over time that will build. And I've been doing that on LinkedIn. It's been working great. And I really only started that in May. And I was always reticent to do that because you've got to get over cringe mountain of posting, and everyone obviously is very reticent to do that, but it's actually not that hard. Once you start posting, you get in the cadence, and as long as your content's good, you get great engagements. You're actually learning things from this. You're creating an audience. You're creating more relationships. You're creating not just deal flow or opportunity flow, you're creating relationship flow because you're building a community for yourself. So
Yeah.
I think massive value in that, and everyone should be doing it.
And I think personal branding has always existed, right? Whether it's, via networking events or thought leadership pieces that used to be in magazines or industry speeches, right? The idea of personal branding has always existed, but I think a lot of these social platforms have made it, and webinars and things like that, and podcasts have made it more accessible to build a personal brand for very cheap and at scale. I mean, I'm similar to you. I don't have any other social media really other than LinkedIn. It's, getting over cringe mountain was one of the most difficult things for me. But,
Yeah.
I'm a little less than a year into posting and producing content, and it's been incredibly valuable for our business. And I think, when we look at what we really are excited about in 2026, it's really about doubling down on content. How can we create more value of content? How can we partner with more experts within niches to create content where it really adds value? Because I kind of realize as one individual, the amount of value that I can content and value that I can create has a ceiling. But by partnering with people like you, by other people to produce content, you're able to go to a level of depth that is very difficult on an individual basis.
Yeah, look, it's also a lot of fun. And I think there's an opportunity in PE to create a very good media vehicle. I launched, only recently launched a site called notveryprivateequity.com because I also think what's broken in PE is the media landscape in PE. If you look at the news resources for PE, they're slim and they're pretty boring. They're very bland sites who report
Deal
on
announcements, deal
the
announcements.
announcements
Yeah.
and fundraisers, and there's a lot more happening in PE than that. You could be a lot more insightful and just a lot more interesting reporting on PE than that. So I think there's an opportunity there. And also in private equity events and conferences. I've been to a lot and they're terrible. You know, the content is terrible because most of the content, probably 100%, is vendor funded. The vendors are paying for these panels. The vendors are paying for these keynotes. So you turn up and you get a quasi pitch deck or sales presentation. So you really learn nothing from what's out there right now. So I think that's another opportunity to build out just a differentiated brand in private equity that is authentic, that goes a lot deeper than just deals and news. You should still report on that, but you should also have an angle and be provocative and be honest around those deals and news, not just straight, this fund just raised 1 billion, blah, 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 done. You should comment on that. Was that a down raise? Was that an up raise? Has this company been successful in the past? What's the chances of this performing? There should be a lot more opinions in PE than there are. So yeah, I think that's also a big opportunity to disrupt private equity media.
The announcement shouldn't be that you closed a new platform. It should be, how you sourced it, why the management team picked you, and how you're going to add value, right? Like, I think that creates a narrative, and so much of, I think the narrative is sometimes lost.
Yeah. And there are also just fascinating stories in private equity that don't emerge. I posted about one because it was a historic AA holding on SRS distribution, which is probably one of the most successful private equity stories out there. No one's heard of it.
Yeah.
SRS was a distribution business, and it passed hands through PE and just grew incredibly every time. And then Home Depot bought it for billions. I don't remember the exact number, but that's one of the most successful stories in private equity. And most people have never heard of SRS. But
Yeah.
you should be putting out more content like that. There are horror stories as well, like Toys R Us and hundreds of others that didn't work out in PE. They're also super interesting to see what didn't work and what went wrong. So there's a ton of great content out there that nobody's putting out or exposing.
Yeah, and I think the content that is out there tends to be the Toy Story deals of the largest scale that go bad, right?
Yeah.
Because I do think, like, especially when you're talking about companies at the scale that we're talking about, and then the deals that the big 5 or 10 are doing, there's very different value creation levers you're pulling. And a big part of when we speak to owners often is they have a real lack of understanding of what private equity is. And that's generally a bad thing because they only hear the bad stories. So I
Yeah.
think as an industry, it's doing itself a disservice by not telling the good ones.
Yeah, because it's that secretive, right? And it holds its hand so close to its chest, and I don't think it does it any good. Because you're right, that most of the stories that come out are about bad private equity, and I think that's only a small part of the industry. But
It very much is.
those are the news stories that get exposed.
Yeah. And it's funny because you'll often like see the comments on like a news article, and it's like, how does this ever work? Private equity only does things like this. And it's like, well, it works because this is a subset of the market. Most of the time, it's a
Yeah,
beneficial thing for owners, for employees, for the parties involved, right? But yeah,
that's 90% what gets published.
yes,
P destroyed my company. P is bad for the world. P is bad for industry, and it's really not. But there's no one putting true content out there to show, well, actually, that's not the case. There's 1,000 stories where P came in. They made that company very successful. That impacted the workforce. That impacted hiring. There's a lot of good stories out there. They're just no one publishing them.
and for a lot of founders, it's the thing they've been working towards that they otherwise might not have been able to achieve, right? And that's a liquidity event for maybe a lifetime of hard work. I mean, we recently closed on a deal, and the guy started the company when he was 16,
Yeah,
and he was 58 maybe now. That's an incredible story for him to be able to tell.
exactly. That's why we need more social, more creators, more people telling these stories.
And when you think about as a young employee, and maybe you're an associate and it's your first job in PE, how do you think about just diving into content creation? Like, what's your advice on just getting started?
Well, look, I think if you're in PE, it's tough because private equity normally locks you down, so you can't post on social. You can't say anything. So yeah, I think there are systemic barriers if you're in PE to posting, unfortunately.
And I think you see that changing, especially at the lowest level, right? The smaller funds that really see the value in it. You're starting to see more and more content creation. But we built a tool internally that gives us content ideas, and it follows a lot of people like you. And well, I guess the problem is it doesn't follow a lot of people like you because there's not many of them out there. When you try and find people that are creating really valuable content within PE, there's a very limited list, right? So I think,
But you're right, and so the other guys doing it. More, in fact, you're absolutely right, and I can. That's the differentiation that I bought and discovered, and why I keep doing it. That there aren't many voices in PE, and the other ones that are emerging have worked in PE but don't work in PE anymore, and they still love PE, and they see the opportunity in PE and want to help people in PE. But now they can post. Now they can post and start creating newsletters and brands and start creating good personal profiles themselves. But there's very few, I can't think of any in private equity that do it or do a good job at it.
There's a guy named Edward Young that recently left, who I think is, he was actually, we filmed a recent episode together, but I think he has a very fresh outlook on what he's trying to achieve, and is a great kind of telling it through my eyes stories, and bonding with the universe.
Yeah, Edwin's a great guy. But I mean, that's the opportunity. I would say back to your first question, how would you think about in PE? You can't post, but just learn, and think about what you would post and develop opinions and just develop the insight. So at some point, if you leave PE or you start your own business, you've got a very good opinion and good insight and good content ready to go.
Yeah. No, that makes complete sense. So I guess with all that said, now that you've taken a lot of that dive out of PE and are posting more and are doing all these things, maybe you could just talk about what you're working on and where you see yourself spending time in the future.
Yeah, look, my vision for Claymore is I'm building a private equity firm backwards. The challenge I also always saw in PE was not having that platform, not having that revenue generation engine built from day one. And it's a massive opportunity because I've done it 20 times. It's been exceptionally successful every time. So right now at Claymore, I'm working with a handful of PE firms across a number of portfolio companies, building out that foundation and building out those revenue generation engines. And it's pretty simple. And again, I'm transparent about this. And it's what I said earlier in the podcast. You do an audit, first of all, and you look at the customer journey and you take time to understand the business and the business model and how that business makes money. A lot of companies don't have that mapped out. They kind of know, but they've never mapped it out anywhere. So you map out that, and then you say, okay, what tech stack do I need to make this business successful and create a business built on data? Once I've done that, what BI do I need to put in place? And then when I've done that, what's the fastest way I can start generating business? And digital is the fastest way. So then you say, okay, what's the digital plan? How do I put in a very good digital plan and give them competent digital people to start driving transactions or start driving leads or start driving lead flow into that business? At Claymore, we build out lead generation machines or revenue generation machines built on tech and built on digital for these businesses. But if I frame it another way, I'm really building out the operating system for a PE firm. I'm building it backwards. I'm building operations first, then investment. So it's my plan at some point to either partner with a fund or raise a fund to say, right, now we've got this revenue generation platform that I could drop on any business from day one and get this built quickly and start driving meaningful revenue. So what do attractive businesses look like that we should just buy, or if I partner with someone, buy together with the thesis of saying, look, if we start this day one and not year three, like most companies do, we could probably move fast on this and exit in 3 years. Not wait for a 4 to 5 year exit on the typical vintage, a 6 to 7 year exit. If you do this right from day one, you could build a good business and exit in year 3 and still earn for a 3x multiple. And that should be pretty compelling for LPs. So that's the end game for me in this.
I think it's a really interesting approach because, one, I do agree with that, right? That, the approach for a fund is kind of backwards in that, like, you get the money first and then the deal, and then it's how do we create value, right? When it's if the GP is capable of adding value in a way that becomes apparent in diligence, the capital falls into place, right? If the deal and the ownership aligns with the sponsor.
Yep.
And there's a ton of value there. And I don't mean to say the capital falls into place to simplify it, because it's incredibly not simple. But, that if everything else aligns, then that the real ability, like the way to drive returns is to be able to add value as quickly and meaningfully as possible. And if you have the infrastructure to make that on a repeatable process, that really is, it's key to building trust with the owners and allowing you to have the opportunity to do it the second, third, fourth, fifth time.
Exactly. And you'll have multiple reps under your belt to say, look, it's the same model every time. Because when you're building out these machines, it's pretty much industry agnostic. What I think about it is at a parent level, you've really got three industries at a parent level. You've got B2B, you have B2C consumer services, and you've got B2C product or D2C. And D2C is the easiest one. And you'd expect these firms to have good tech stacks in place and good operations, but you've got the attribution. So you transact straight away. You can see what drove that transaction. You've got full insight. Consumer services I like as a sweet spot because you've got usually resilient industries that haven't moved with the times. And the sales cycle is probably a week. From getting that lead to closing the lead is probably a week. You can still run good attribution on that. So I think that's a massive opportunity. B2B might be the biggest opportunity because those companies are so far behind when it comes to lead generation. The challenge there is twofold. One, the sales cycle could be 6 to 12 months. So you could put the best marketing engine in place. You won't see attribution for 6 to 12 months. So that means the other issue is you've got to have an awesome sales team and a data-driven sales team, and not many companies have those. Right, you've got to have a superstar running your sales team who's going to discipline their team to say, we manage a funnel, and you enter data every day to help marketing understand that funnel and what they're getting for their spend. And if you do that in B2B, I think there's a massive opportunity, but it's harder because they're stuck on old systems. Their sales teams are typically not data driven, and it's a long sales cycle. So it's a lot harder.
Yeah, well, it's funny, this is tangential, but you brought up this point that sales and marketing are intertwined in a way they never have been before. Part of that is attribution, but part of that is strategy, top of the funnel as well, right? Because, the sales team now is often what, is becoming a content source. They're becoming top of the funnel, but at the same time, they need marketing to move through a funnel like you never have historically.
Yeah, it's a shared outcome, right? You both want to make money for this business. Historically, there's always been a war between sales and marketing, because especially in B2B, the sales team are being all about relationships and steak dinners and hammering the phones and finding clients. And they've always seen marketing as branders, who are going to drive the brand. It's a nice to have, but sales is really the engine of this business. Well, that's not the case anymore. Today, of course, sales is hugely important to close the deal, but it's never been easier to drive leads. You shouldn't have a team sat on the phones cold calling every day. That's marketing's job. Marketing should be building that lead generation machine for you, not only to drive a volume of leads, but to drive quality leads. And if you've got the data, you'll be able to understand that. So that should be a dream for salespeople because they should be getting handed a volume of quality lead every day. That then it's not a cold call. They call that person to start relationship. They close the deal. So yeah, it's absolutely, they should both be working hand in hand now, but marketing should be making the sales job a lot easier.
Yeah, I mean, look, it doesn't matter if you close at a 20% better rate if the other person is pitching 3 times as many people, right? The thing about the marketing sales debate is now, more than ever now, lead generation scales in a way that sales doesn't without body count. Unless you're, in certain SaaS products. But that's one of the things, it's like, I always say, it's your marketing engine should lead your sales growth. Right? You should be hiring and growing your sales team to keep up with the lead gen that the marketing does.
Yep, I agree.
Well, I guess on that note, I think when you think about the future of private equity and the future of digital within that, what are some of the things you see kind of coming down the pipeline?
I think, look, AI is going to play a big part, but there's a lot of noise there right now. I'm getting pitched by AI companies every day. It's about that they're selling futures, right? They're selling, here's the future of AI. It's going to do everything. It's going to be amazing. Give us all your data and we'll come in and create a blueprint. And they've got no idea what they're going to create, but they want to figure it out. And I don't love that right now. So I think AI is noise. It's also noise for portfolio companies because a lot of portfolio companies are thinking about AI and they don't realize they're not set up for AI at all. A lot of conversations I've had where the question is, what do I do in AI? And my pushback is, well, first of all, you need data. You haven't even got a CRM, or you've got a CRM with no data in it. And AI is not a magic wand. So first of all, you need to build the foundation. You need a tech stack which delivers you data and then think about AI after that. So most companies are really not set up to leverage AI. And then back to the vendors, I mean, I get it. AI will change everything. But for now, I would say just focus on the AI products that work really well today, like voice in call centers. That's proven. That works. Leverage AI for that. AI for content creation. That works. So just start with the things that work. To your question, what changes in PE? I think they have to become a lot more operationally minded and start building out better platforms, figure out, how to use operating partners well and effectively. And that's still broken because if you ask 20 PE firms how you define an operating partner, you'll get 25 different answers back. So I think it's really figuring out your role in value creation and exactly how that relationship is going to be with the portfolio company and how directional you're going to be and what you're going to insist on that has to happen in those portfolio companies. So I think directionally it has to be and will be a lot more operationally driven than just a financial vehicle.
Do you think you see operating professionals becoming more ingrained or even part of deal teams in a way that doesn't really exist right now?
It depends on the firm because it does exist in some firms. Like operating partners will be at the table in the diligence, and they should be. Because if they're going to improve the company, you want them at the start to actually say, well, can I improve this company? Has this company got the bones to improve? What's the opportunity? So I think that happens now. It's just inconsistent across the industry, but that should definitely be happening. The operating partner should be in the diligence right the way through that to actually creating value when they buy the business. They should be shoulder to shoulder with deal partners.
Yeah, I couldn't agree more. Well, look, Lee, it was really great to have you on, and I really appreciate the discussion. I think how we look at the world really aligns in a lot of ways, and it's great to just hear your expertise and your insights from doing this at a very large scale across a large number of companies, and really seeing what's been successful and driving results.
Cool, thank you. I appreciate the time.
Yeah, have a great day.
You too.